and welcome to BloombergQuint. With the April monetary policy out of the way, in some ways, we've kicked off the new financial year in earnest. Lots to talk about, as always. We've been hit with a second wave. That's top of mind. Questions about inflation, what monetary policy is doing. We thought we'd check in with Abheek Barua, chief economist at HDFC Bank, for answers on everything that's plaguing our minds right now. Abheek, thanks and welcome to BloombergQuint.
Sure, my pleasure.
Abheek, a bunch of questions, but I'm going to start with, I think, what's top of mind, right? I mean, just about a month back, it seemed like the pandemic situation was looking a little bit better. Life was getting back to normal, but there's been a violent resurgence. How are you seeing this from an economic perspective at this point? Where do the tipping points lie?
But I mean, it's different from the first wave, and the damage to business activity and so forth will be somewhat limited. But if you see the experience of other countries, the second wave, and you need pretty intense skills with between some kind of COVID appropriate behavior. So having said that, I mean, I think it's going to be a difficult challenge. It will involve aggressive containment, which is going to sort of affect mobility. It's going to affect business activity. So I think, and if you look at the states that have been affected, if you take the top, say, 4 states, they roughly account for about more than 40% of our GDP or GVA. So I wouldn't sort of certainly wouldn't play it down. And with all these mutants, I don't understand much of epidemiology with all these mutants around. I think even the efficacy of the vaccination program might just be sort of compromised a little. So I'm worried. I would tend to be concerned.
Okay, Abheek, so before this hit us, and rightfully we are all sort of grappling with how and to the extent this will impact the economy. But what were things looking like to you before the second wave hit? Was the economy recovering better than you would have anticipated? There was much talk about the fact that there are labor market scars which may not be showing up in sort of the first set of data that we see. Was that in any way coming through on what you were judging consumption to be like, or was it not?
Yes, my sense was that it was certainly a V-shaped recovery if you look at some of the headline numbers. But a V-shaped recovery is entirely compatible with a K-shaped recovery. I'm sorry, I'm sort of getting bogged down in the alphabets. But I think what is clearly seems to have happened is that the organized sector, which wasn't really that affected in the first place, saw a very smart recovery and an unexpectedly smart recovery, and a lot of things that went with the initial phase of decline, like salary reductions and so forth. They were reversed over a period. So if you look at consumer demand from that perspective, the hit got corrected. But I think there was a lingering problem with some of the lagging sectors, the contact-intensive sectors, which certainly didn't do as well in the recovery phase. And of course, with the large informal sector, self-employed persons, so forth. If you go by the level of the defaults and the loan impairment, even in unsecured personal loans, wasn't as high as we had anticipated because of the problems in the informal sector. So perhaps it's the informal sector did also kind of pull through rather well, but it was certainly more affected by it. Let's see. I mean, but I'm sure that the impact on the informal and the semi-formal sector was more severe. I think a lot of the really small entities are still hurting because of supply shortages as well as demand issues. and so forth. And if you notice that, if you look at the credit categories, the segment in terms of credit offtake that's really lagging behind is the very small.
Yeah.
So the mid-size mid to small schemes. So you see a massive traction there in credit demand. But if you just go below that, that's a segment which, in terms of credit offtake, also was lagging with sort of significantly negative sequential and YOY growth. So I would guess there's a problem there and hasn't been resolved. And now with the second wave, I think it's just going to sort of exacerbate their problems. I mean, small is never beautiful, in terms of having access to credit and or being in a healthy operating environment. And now with the pandemic resurfacing, I think the problems will just get compounded. So I would tend to worry about, again, I speak from a sort of with a banker's hat on, the MFI, the segment that the MFIs, the microfinance institutions were servicing, the segments that the NBFCs were servicing, and banks were sort of trying to access that segment by lending to NBFCs. Those are the segments that I think were sort of hurting relatively, and will hurt that much more again in this new wave.
Avik, I'll skip a step and come back to inflation in a bit. But yesterday's monetary policy, for instance, did keep a focus on growth to a large extent. Even the guidance is framed in a way where it's about reviving durable growth, or growth in a durable manner within the construct of the inflation targeting framework. That's appropriate at this point, given all the uncertainty that we've seen. Although we're not really seeing any much more support in terms of interest rate policy into that objective of growth.
Right. So I think they're depending largely on liquidity to do the trick. So I think, as Dr. Patra pointed out yesterday, because they're not, transmission is limited by the fact that they're not doing much on the rates. But what they've decided to do instead is just push a lot of durable liquidity, literally throw money at the problem, and hope that banks with so much liquidity on their books are forced to kind of revise rates down and push credit. And this will invariably have to take place at lower rates, because if you want more credit demand, you'll have to offer a better price. So I think that's the tack that they have followed. And so it's a peculiarly sort of dualized monetary policy framework, where you take care of the sort of the inflation management signals through your conventional rate framework. But you keep that, because of inflation risks, you keep that static, but you try and get as much done as possible on the growth front through liquidity, which is potentially kind of dangerous also for inflation. And I think it would be far more difficult to defend yesterday's policy if it were not for the second wave, because I think it has yesterday's policy, de facto has the characteristics of a crisis management policy. And given the numbers of the last couple of days, it sort of kind of justifies it. But if indeed the economy was recovering and there was no second wave, I think we could ask a lot more difficult questions about the wisdom of pumping in so much money into the system and kind of fretting so much about bond yields when inflation is not just confined to some transient categories like vegetables, or it's not just a sort of a fuel price shock. It's considerably dispersed and entrenched. If you just look at the core inflation components, it's very clear. And I think this, I think we don't really understand the inflation formation process in India, and we tend to sort of go by these broad macro rules that if you have a negative output gap and sort of below the potential output growth, which is which is typically what happens when there is a shock like a pandemic. You shouldn't have core inflation. You shouldn't have inflationary pressures, or whatever the inflation pressures are coming through are supply side driven. I think our sort of market structure and price formation process is far more complex than that. We have structural deficiencies in a number of areas, and you kind of see the interplay of demand and supply, demand push, and supply shortages play out in very peculiar idiosyncratic ways, which are somewhat sort of specific to the Indian case. So just betting on this macro thing of okay, we have sub potential growth and hence there shouldn't be inflation simply doesn't work. But you can't, as an inflation fighting a central bank, sort of just say that if it shouldn't be this way. You have to take into account the realities of the situation. The reality is that we've had sticky and rising core inflation. Might come off a little, but that's certainly an issue. But again, sort of getting back to what I was saying, that so these questions would aggressively asked if it were not for the second wave. And now that there's a second wave, I think this is sort of playbook or textbook crisis management policy, throw money at the problem, which is what all other economies have been doing. So yeah, that's the way I see it.
To what extent is that working so far? Or rather, how's that going for us? It's not like credit growth has picked up in a huge way. Yes, the counterfactual is that, if this liquidity wasn't this surplus, maybe credit growth would have been even weaker than it is currently. Where is it helping this whole sort of liquidity rush? It's all coming back to the RBI. I think Abheek's phrase.
Lots of these things have to be looked at, and
Sorry, Abheek, I'm going to try that again. Your phrase, your
is it
line
okay now?
Yes,
okay. Okay, right. Ask the question and.
Yes. Let me just reword that question. I was just asking whether it's working, this whole throwing liquidity at the problem. It doesn't seem to be generating a large amount of credit growth if that's the channel that we were hoping for.
Well, I think a lot of it has to be justified by using the counterfactual. And if you remember the great financial crisis, which both of us saw pretty closely, most of the justifications of quantitative easing were provided in terms of by referring to the counterfactual. What would have happened if we hadn't done this? So that's in a situation like this, that's typically what you tend to do. And also, if you just look at the kind of contraction that we've seen in the economy and credit growth seems to have kind of considerably outperformed the headline economic activity indicator, which seems to suggest that yes, there was some kind of an impact of expansionary monetary policy. And then if you drill it down to credit dispersals, some of with the credit guarantee and so forth, there's clearly some segments which benefited hugely from this. And I would again sort of draw your attention to the medium and medium companies, which saw a considerable expansion in credit. I think the problem was also that large companies started deleveraging, they overborrowed, and so that's a problem that's appearing for that's surfacing for banks, because the large companies want to pay back and not borrow because they want to be sort of relatively debt free. A lot of money has been raised through the corporate bond market, through alternative instruments like CDs, CPs, and so forth. So I think if you look at the sort of the totality of it, I don't think it was as much of a damn squib as some people would make it out to be. Clearly, there are pockets where it hasn't reached, and that's a combination of unwillingness to lend because of risk, and also perhaps diminished need because they've been so badly affected in terms of input supply and so forth by the pandemic that they just don't need credit. But certainly it has, if you look at a disaggregated picture, which the headline number kind of obfuscates, I think that you can sort of say that it's been a mixed success. It's not entirely, it hasn't fallen flat on its face.
Okay, a couple of last questions, Abheek. One is on this GSAP program that came in yesterday. Amazing amount of focus on keeping long-term rates down. Justified, and what is it? I mean, yesterday there was this big debate. The forex markets were seeing it as QE, and some thought they were reacting to that. Others were saying it's yield curve control. Someone was saying it's just repackaged OMO. What did you make of it, and what's the end objective again?
But ultimately, all these things, I think, monetary policy, or the monetary system is actually very simple. I mean, all these things ultimately have pretty much the same effect. But I think it's largely motivated by yield management, which is something that the central bank is particularly committed to. And I think they have provided some kind of a rationale, and it's also sort of justified by, and they've tried to sort of justify it in two ways. One, that there are other central banks who are doing it perhaps more aggressively, and it does have large benefits, especially if there is expansionary fiscal policy to get you out of a major shock, and you're trying to sort of reduce the cost of this fiscal expansion. And the other thing is this business about it being the public good, which is kind of debatable. Something so in mind, there is a fair level which is compatible with fundamentals, etc., that they want to ensure, and so yield management sort of comes in there, and it is it is quantitative easing of some kind, and there is a sort of a semi-calendar for it, with although just for the first quarter there was this assurance, I think, to your question, that if there's a 1.2, then there's a 2.2 will naturally follow. So if you are sort of if you go by that logic, we do have a quantitative easing program. I see some justification for it, really, but I think the problem I have with this is that right after the budget, there was this sort of manic effort to keep the yield below 6%, despite the large borrowing program, despite the inflation concerns, need the macro situation very different from what it prevailed, say, 3 months previous. So I think the RBI has kind of, I wouldn't say learned its lesson, but I think it's seen the light of reason, and it doesn't want to hold the rate, come what may, at a particular level. They're saying that it will be an evolving rate, but so it might just go up if the underlying demand supply situation or some of the macro or variables and hold certain levels, but this would be along maybe a rising curve.
All right. We're not having great luck with the connection today, but I will try and squeeze in one last question, and that's on the currency. I mean, it does seem like, when you're trying to balance so many different conflicting objectives, something has to give. And there's almost sort of like a pressure cooker-like situation that seems to be building on the currency front at some level. Is there risk there, with US yields rising, dollar strengthening? Is there possibility or at least volatility on the currency? I know we've got a ton of reserves, and that will help.
Yeah, certainly. And I think this business of or the perception that this announcement of monetary easing, call it QE or whatever you want to, is certainly having an impact, apart from the sort of the renewed concerns on the economy. So the rupee will be under pressure. There will be volatility, and again, I think trying to defend a particular level beyond a point is just not sensible, and it's also difficult to do. So maybe if we have a more sort of gradual depreciation, it's good for us. Maybe it sort of brings in a bit more of imported inflation, but we're certainly not in a situation where there'll be a run on the rupee, or a depreciation on the rupee should be construed as sort of a signal of external macro instability. So I wouldn't worry too much about it.
All right, Abheek, I'm
I have a
gonna.
lot of things I think we have a lot of things to worry about.
Absolutely. Abheek, thank you so much for spending time helping share your views on all that's happening. We will have Abheek's views up on the website as well, since the connection wasn't great. But thanks so much for watching. Abheek, thank you.